as an investor, on behalf of Mike Bloomberg, one of the big stories, not just this week, but this year, is the COVID virus. Now we have the Omicron variant. None of us, I dare say, are epidemiologists. We can't know what's going on. And by the way, even if we were, I don't know that we could predict what's happening with the virus. But as an investor, what do you do about that? Because it could well affect your investments.
Of course, it has affected our investments. And I would say in several decades of investing, I've never been in a position where I had to analyze things like this that went way beyond the normal parameters you look at as an investor. And so it has introduced a level of volatility into the markets. It's introduced a level of inefficiency into the markets. You see stocks reacting in strange ways and not anticipating events the way the market is usually good at. And so it has made life very, very complicated.
And as an economist, Larry, one of the things that it may well affect is the supply chain problem that you just mentioned in the last segment.
I think one of the big questions about any time we're talking pandemic is, the way I like to say it is, how does it affect the number of bartenders relative to the number of bar customers? Because the thing about the pandemic is that it affects both demand and supply. And so you know it's going to be bad for the level of output because there's going to be less demand and less supply. But with less demand and less supply, you don't know what it's going to mean for prices. And that's one of the puzzles in a lot of the discussion. Everybody said a year ago that, a year and a half ago, that we needed all kinds of stimulus because of the pandemic coming. Now, there are many people who say the Fed doesn't need to tighten because the pandemic is going to end and people are going to come back to work. Those can't both be, or unlikely to both be proper logical propositions. I think Omicron does introduce substantial uncertainty into the future, and probably even more for emerging markets than for the United States and Europe. It does certainly put an extra range of uncertainty. And I also think that we shouldn't be so callous as to analyze it entirely through the prism of markets or the prism of GDP statistics. Even if it doesn't have any effect on mobility and lockup policies and people are still flying planes, a much more pervasive virus is going to have a set of human consequences.
Well, that's a fair point. I know you'd agree with that, Steve. First and foremost, it's a matter of personal health and safety. But it does affect investments and does affect money as a practical matter. You have investments around the world, not just in the United States. Are you seeing a divergence among the markets according to actually the COVID? I mean, right now we see very different approaches. I mean, China really locks down pretty quickly to try to protect themselves. Europe, parts of it now are starting to really shut things down. Do you see a divergence in investment based on that?
Not really. You know, they are pursuing different strategies, but I'm not sure whether the COVID strategies are the biggest driver of economic differences. I mean, for example, China, there's an enormous amount going on in China. President Xi, we don't have time to talk about it today, but he's fundamentally changing the nature of China's approach to the market economy. That is far more important than the fact that China has its own approach to COVID versus how England approaches it or how Austria approaches it or this or that.
So, Larry, what about that, the approach of shutting down as opposed to vaccinating? Two very different courses have different economic effects.
Yeah, they do, certainly while you're locking down. I think what I have been struck by in general is that the policies seem to have more effect on the timing of the disease than they do on the overall level of the disease. That if you lock up, then you reduce the disease substantially for a while, but you have to unlock at some point, and then you get most of the cases that you avoided. If you look at the different countries within Europe, there are a lot of different strategies, but less difference in result. Part of what I think has to be a concern, you know, when people talk about China, they always talk about Evergrande, and that is certainly a very big concern. But China, which has had nothing much happen that has increased its immunity levels, virtually none of the disease, vaccines that appear to not be nearly as strong as the ones we've used, how they're going to work their way out of their totally locked up situation, I think is a very big challenge. And the longer they stay locked up, the bigger that challenge is going to be.
No, they're going to have Olympics, which will open them up. And Steve?
Well, they're not going to open up for the Olympics. They're going to do the Olympics in a bubble.
Yeah.
And look, what I've heard about China and their vaccination strategy, nobody knows, of course. The speculation among people who know something is that between now and a year from now, when the next Party Congress occurs, they will figure out how to vaccinate people with vaccines that actually work, and they will then start to open up. Is that right? I have no idea. But let me just say two other quick things. One, I do think we're learning to live economically with the virus. I sense among my colleagues, among people I deal with, so far no one is flustered that much by Omicron. We're still in the office, people are still having meetings and so on, and it's something we're going to have to live with, like hijackings on airplanes. You just have another way to approach it. The second quick thing I'd say is I don't believe that the reason people are not working now is because of the virus, generally, obviously exceptions. I think the reason they're working right now, frankly, is many of them don't have to. They have strong balance sheets. They don't want to go back to an Amazon warehouse. I don't want to go to an Amazon warehouse. And so they're taking their time and figuring out what they want to do. And there are 11 million jobs open out there, and they know they can get one whenever they want one.
Yeah, really important point. Let's wrap this up now, looking forward to 2022, if we could. Larry, start with you. As you look forward to the new year, what do you think the biggest downside risk is that we face?
I think there are three risks: Omicron, inflation, and overextended markets are the three biggest risks we face, and I'm not sure in what order. And I'd also say the geopolitics of China, Russia, and Iran, all of which are potential sources of crisis in the next year, is an additional concern.
What about the full valuation, should I put that way, of the markets right now? What about that? What will correct that? Because they seem to have been almost impervious to all sorts of different slings and arrows.
Well, you know, if you look at the top stocks are down only a couple percent. The stocks outside of the largest caps are down 20% on average within the S&P. So I think you're getting to a more bifurcated market. I mean, Steve follows this much more closely than I. But when the idea comes that we're really going to see interest rate tightening, if I'm right that it's going to take more than 50 basis points or 75 basis points to get inflation under control, and that idea gets into the market psychology, if, as always has been the case before, Fed efforts to slow inflation lead to recession, I think all of those things are sources of risk for the market.
Give us 1 minute on testing. You identified Omicron as a big risk. Are we testing enough in this country?
No, we're fixing it now, but we're a year late to pervasive, cheap tests that you can give to guests to your home and get a result in 15 minutes. And the faster we move on that, and the stronger we move on that, and the more universally we move on that, the better it will be.
So, Steve, same question to you. Looking at 2022, biggest risk?
I agree with Larry's three risks, but I think the first one and the third one are linked. And I think when you get to the question of why are the markets so frothy, I think my own personal view is that the vast majority of the reason is the Fed. That when you take interest rates to zero, you know, it's TINA, what we call TINA. There is no alternative, and people come into the markets. And what you see happening right now is that every time there's talk of interest rates going up, the stocks that get hit hardest are the growth stocks, because their cash flows are so far out in the future that when you put a discount rate on it, the values go down as interest rates go up. And so I think the market is not really responding to international strategic issues. It might if they became more severe. I think the market's responding almost entirely to interest rates. And if the Fed starts down this path, I think it is going to be a tough ride for the market.
Well, that's my question, because start down the path. We've had it pretty clearly from Jay Powell. They're going to start down the path. The question of how fast and how far. So do you think, would you feel better if there was a bit more of a taper tantrum?
I'm not asking for a taper tantrum, and obviously part of why I think the Fed has moved so slowly is to avoid a taper tantrum. I think they've successfully mitigated the effects of stopping the asset purchases, the $120 billion a month. I think the market's accepted that. I'm not sure the market's ready for 3 interest rate increases next year, and I think that may come as a shock to them.